We have 2.5 million businesses in the US that are owned by baby boomers approaching retirement age. As we go through the transition of who is going to own and operate those businesses going forward, it tends to be folks that have more of a digital native orientation and are looking for ways to run the businesses differently. So when we see those two things coming together, to us, that is a strong signal of where an inflection point in reindustrialization and sort of the adoption of technology is coming from.
Hi, everyone. This is the One Point Podcast, and I'm Rohit Yadav. Welcome to this new streamlined format that is shorter, sharper, and more impactful. In each edition, I'll spotlight either an insightful trend from the ecosystem or a thought-provoking perspective from a venture expert, or a bold idea worth exploring further. And today I have Jackie DiMonte with me, whose posts on US industrialization were quite intriguing for me to invite her on this podcast session. Jackie is a co-founder and GP at Grid Capital. Previously, she was partner at Chicago Ventures, and before that, she was with Hyde Park Venture Partners. So Jackie, thank you so much for joining in because your posts are just fabulous.
Thank you. Thanks for having me.
Yeah, so let's get right into it. So what is Grid Capital?
Grid Capital is newly formed fund. This is our second year in business. We lead formation stage rounds, so typically pre-seed or stage rounds in companies serving critical and physical industries like construction, manufacturing, supply chain, et cetera. Tend to invest in a meaningful way. So we have a somewhat concentrated portfolio. And we like to say our check has to matter to founders and vice versa. And we like to sort of get our hands dirty in those earliest stages as companies are finding product market fit.
And since you started a couple of years back, tell us the background of starting Grid and maybe some of the portfolio highlights.
Sure. So Grid really goes back about a decade at this point in terms of our partnership. My partner Peter and I started in venture as sort of the junior folks on the team a little over a decade ago. And because we were at competitive firms, most of our conversations were oriented around firm building, where to create edge for ourselves, right? In competing against not just brand name funds, but partners at brand name funds, and where, sort of developing edge actually could matter. And you overlay that with the fact that both Peter and I came from more industrial operating environments, him on, sort of more of the growth, go-to-market side, mine from more of a technical product-oriented visualization. And then, sort of our early experiences in adventure were with funds that were tied to, what were previously non-consensus investments in supply chain and logistics, companies like Project 44 at Chicago Ventures, or I was at Hyde Park with Four Kites and ShipUp, all today multi-billion-dollar companies. But you start to see how this reinforcement of really understanding what drives motivations and incentives behind customers can really lead to edge in both sourcing, but understanding sort of the true market potential of these companies. And so as we sort of built on our careers, we went deeper and deeper into these more industrial environments until we got to the point where we said, look, we want to be partners together. Chicago Ventures has been working together as partners for, around 3 years, and really wanted to capitalize on what is this reindustrialization inflection point that we saw coming.
So, Jackie, let's move to the core of this discussion, which is your post and your ideas around reindustrialization moment. So, you have written about this being the reindustrialization moment for the US. And what do you think, why this period is different from the others, and how is American manufacturing being revitalized?
Well, we think about today's reindustrialization movement really happening based on two colliding forces. And this has been sort of a proven pattern, right, in terms of opportunity and adoption. And that is one, when there's a major platform shift, right, technology shift. And then on the other side, where there is a major people or demographic shift. In terms of platform enablement, feels very, very obvious at this point in time. But really, in particular, In particular, as we see it related to reindustrialization, it is a new way of delivering value that was like previously locked up, right? When you think about historically going from, sort of on-prem or custom software to the cloud, a lot of times that was, easier to use, more accessible, et cetera. But it wasn't, sort of clearing the bar for a lot of these manufacturers or construction companies to just, kind of keep hopping to the latest innovation. Today, what we see with AI and sort of the capabilities there with automation and really sort of like unlocking different capabilities is that the ROI equation actually makes sense in adopting new software. I went from saying, hey, I think this will be easier for my operations folks to use to now, hey, I can actually have them working at a much higher, sort of level of efficiency and quality. So that is one where we see the supply of technology actually growing and maturing in a way that is valuable to the ecosystem. And then the other side is on the people side of things, right? We have 2.5 million businesses in the US that are owned by baby boomers approaching retirement age, right? As we go through the transition of who is going to own and operate those businesses going forward, it tends to be folks that have more of a digital native orientation and are looking for ways to run the businesses differently, right? So when we see those two things coming together, to us, that is a strong signal of where an inflection point in reindustrialization and sort of the adoption of technology is coming from.
Okay. And would you want to bring the context of geopolitics and bring the industrialization back or manufacturing back to the US in this mold?
Yeah, I mean, I think in terms of the overall push to reindustrialization, we saw both a push and a pull domestically. So 5 or 6 years ago, we saw the CHIPS Act and what was the infrastructure bill come through, which was mostly around let's invest locally, right, in terms of manufacturing capabilities, creating a robustness in our supply chain. Very quickly, you saw some wars come on. The Ukraine-Russia war was sort of the first time where everyone was jolted and said, okay, there is a reason, right, for us to really think about shoring up our domestic capabilities. If you go back a little bit further, we saw the COVID supply chain shocks. As you come on, down the pipe, there's I would say even more of a delicate geopolitical situation. And so that as a backdrop, I think is providing a lot of attention to reindustrialization. It's also providing a huge level of reorientation in terms of talent into who's focused on the sector and where folks' interest really sits.
And you also mentioned about a dual narrative, which means that manufacturing construction is slowing from its peak recently. But on the other hand side, you compare it to the 3x level of the chips era and so on. So what does this mean for the startups entering the space of industrialization, manufacturing, tech?
Yeah, that's right. So the data that you're referring to is in terms of spend on construction to build new manufacturing capabilities. The new starts, or sort of the overall construction volume, is starting to slow. So I think the annualized sort of run rate, if you will, of construction spend is around 225 billion today. That's down slightly from around 240 billion a year ago, but up very high from what was 75 billion, a couple years ago. So 2020, 21 timeframe. This is creating new sort of inventory and capabilities largely across this computer and electrical manufacturing capabilities. So a lot of it driven by the CHIPS Act, but it's also around transportation equipment, food and beverage, et cetera, that also are having sort of some increases in capabilities. And I think what this is more symbolic of is the dynamic environment around these supply chains. And there has always been a need for more automation within these individual factories and facilities. What this is actually indicative of, though, is a much higher level of diversity across a customer base, right? When we think about what our existing sort of capacity or manufacturing and then net new, you are actually deploying technology in different ways when you think about retrofitting versus installing in net new environments. And so when we think about startups and how they're selling to these sort of different ecosystems, it is like how do we really fit within the existing, but also take advantage and power
Last question in this section. Which are the sectors of the US industry do you believe will be most impacted, or in other way, you can say most ready for the renaissance, and which are lagging the most?
Yeah, it's a great question. I think we will get deeper into talking about productivity and how we think about sort of the changes in productivity impacting the industrial sector. But that's really where a lot of our research and focus starts, which is around the worker and the labor force. In general, manufacturing and construction are areas where productivity has been flat or declining, wages are up. These are already low margin businesses and they are getting squeezed. And so for us, it is where can we begin to cut out some of those layers of inefficiency and really reorient sort of those businesses to resiliency. When we think about sort of the adoption of AI, manufacturing has actually been very much pulling ahead in a maybe surprising but exciting way. I think the fintech company Ramp put out statistics recently and said 40 or 41% of all manufacturers were paying on for AI solutions. To me, that is a very compelling number and something that says folks are experimenting and really trying to understand how they can apply this technology to make their businesses, sort of more resilient, more efficient. Construction, on the other hand, was more like 25%. And that is in my viewpoint, both an opportunity, but also a little bit discouraging in that it is one of the markets where I feel like AI has so much room to run, right? There is a lot of unstructured, highly contextualized data that AI is very good at processing. And so that's one area where we're spending a lot of time is understanding what are the different incentives that really compel those businesses to adopt technology.
I mean, I feel like real estate across the world is one of the biggest laggards in technology adoption, well, AI adoption now, but it has always been. You always talk about technology, but you talk about AI and software. Do you see this reindustrialization moment also impacting hard tech startups?
I think hardware is certainly having its moment, especially from a venture and venture backed startup perspective. I think that what we are trying to understand here is where the different points of durability but also capital efficiency lie across those companies. Historically, we think about venture as a power law business, right? And you can see that very clearly in the software landscape. We think it is that to another order of magnitude in hardware, right? You start to see companies like SpaceX or Anduril that have been shown to be the marquee successes, right? In this space, but there were dozens of other rocket companies and defense sort of primes, right, that have been attempted over the years. And so when we think about where hardware is, we're seeing this renaissance in terms of new starts and trying to understand how do we, especially as primarily software or software enabled hardware companies, how do we support this growth such that we can have higher levels of conversion, right, to durability and long-term success. So for example, when we think about hardware companies that serve regulated industries, so you can think about aerospace and defense, transportation, sometimes even food and beverage, right? How do you support those companies such that the typical pitfalls that they might fall into or places where they might spend more time navigating those issues, you can reduce and sort of increase their odds of success and thereby also grow the market for us. So that can be in terms of understanding quality, understanding sourcing, creating sort of backups in your sourcing and supply chain. And so it's all about how do you enable those companies to be sort of more successful and have higher conversion rates to success over time.
You mentioned peeling off the layers, right? I'm now referring to one of your posts where you said better technology is just one of the few proven levers to increase productivity. Where are you currently seeing the real ROI from automation, kind of next gen industrial systems or service platforms then?
Yeah, I think that in terms of where we're seeing the most ROI is where folks are able to start with the lowest hanging fruit, build trust over time, and then get to sort of full layers of automation. So when we think about sort of introducing some of this technology uh, to customers, it starts with just assisting, right? So like let's take something basic, which is sort of like data entry, right? Can you actually convert something from a handwritten purchase order, right, into what is a sort of structured format? So that might be just assisting someone to do their job where they used to have to go here, then manually type and enter in, somewhere else. If you can show that you can do that repeatedly over time with high levels of accuracy, you're saving time. Maybe you can start, sort of augmenting, right, those employees and what they do. And so you take it from this is, what data we're working with to this is what does the data mean, right? So it might be proposing, sort of like categories or who to reach out to for a status on, incoming supplies, something like that. And then as you start to do that, you begin automating more and more, which is like, what do I do with the data? Where does it go? What physical action happens from there? So for us, we're seeing companies that help humans sort of work at top of license, so work at their sort of highest level of capability by doing that, sort of assist and then augment and then beginning to automate and then pushing only exceptions, right, to your human workforce. That does two things. One, helps folks focus on the highest value tasks, but also in an area where we're seeing demand start to outpace what supply is. Again, thinking about this labor pool and the fact that there is, sort of an aging labor pool in manufacturing and construction. It's helping folks that are working slower actually get up the curve and feel and act more like an expert in the field. And so a lot of this is how do we bring folks along and build trust such that when we're ready to do full automations, we have access to that data and those workflows.
Got it. So the first layer of assist and argument is one of the areas where you see the most concentration. Understood. From technology perspective, do you see only the AI, because you mentioned AI a couple of times? AI is everywhere right now, but there's also a new study from MIT which says most of the projects are not delivering worth their ROI in terms of AI. So where do you see AI biggest impact? And from if you remove the AI from the technology context, what other part of technology is kind of really impacting the startup ecosystem?
Yeah, I think that study is a good one. And I think there's been a few studies referencing the level of experimentation right now with AI that has not necessarily delivered ROI. I think in that study, it does also say the more vertical or specific the solution is, the more likely it is to actually be delivering that value. And that's what we spend, a lot of time on. I would say in general, we are seeing, and I know I'm bringing up AI, and you asked me about some other things too, but AI that is attacking BPO, so business process outsourcing spend, as being something that is actually delivering a lot of value very, very quickly. So enabling you to sort of like flex human spend up and down in relation to what these capabilities are that you're adopting over. A lot of times you go from, again, like rote data entry, you start to outsource. Well, we should be able to automate that and allow sort of like BPO to be routing more of that data, right, over time. From where we spend time from a technology perspective, it coalesces around what are sort of like our core operating systems, right? So these are your ERPs, your MESs, as Jeff Bezos would say, like anything that makes your beer taste better. Like we are very focused on where is the white space where there might still be pen and paper processes that we need to digitize and really create the foundational data layers for workflow and automation. For us, there's then the full other side of the spectrum, which is outsource services, right? As we think about anything that does not make your beer taste better, right? Where can you start to completely offload some of those functions to a third party? For something like construction or real estate development, this is a company from one of our prior portfolios, but an example could be if you are a developer, you need permits in order to develop new infrastructure, whether that is industrial space or QSR, quick serve restaurants. And we had invested in a company called Greenlight Technologies, which essentially delivers permits to you, right? So they are a tech-enabled service that both works with cities to be their private plan review, and then works with developers to make sure that the application is in order to get through that process. And what we really saw there was when companies are not viewing something as their strategic differentiator, they don't really need software to just manage those things. They'd rather just get the thing done. And so we're seeing more and more opportunities to take on those critical functions, and remove them from, sort of the organization completely.
Got it. So, Jackie, let's move to the last part, which is always interesting, which is how much fundraising is happening within this sector and the whole overall ecosystem, how the startups are coming along. So, you have argued that the industrial and the hardware startup have more resources than ever before. So, what's driving the shift? Is it just the more VCs which are coming up to focus on these areas? And how is it changing the whole venture capital playbook?
The resources that I talk about in terms of industrial and hardware startups are largely related to talent. When I started my career in venture and you would sort of look at these industrial tech companies, a lot of times you were making trade-offs both in terms of founding teams, but also who you were recruiting between who was a sort of an industrial insider versus folks that had built high growth technology companies before. There was a trade off, or you had to sort of like mash those two sets of people together. Today, we are seeing these sort of happen in teams or even people themselves, right? And for us, it is largely driven by the fact that there are 30 times more industrial technology unicorns today than there were 10 years ago, right? So when you think about a growth in that number of companies, 30 companies, those all are growing employee bases. There's probably 100 or even 1,000 times more people that have both the ability to understand the incentives and customers that you are targeting as an industrial technology company, but also understand what does it mean to be under the burden of venture capital and grow technology and figure out sort of who is the right talent, have those networks, plug in and recruit them. So for us, it's really, really exciting to see sort of that talent pool grow. The other thing that is really exciting is the folks that are actually spinning out of those businesses. So we did this analysis around founder profiles coming out of industrial tech companies and found that on average, 1% of those alumni end up sort of starting their own companies and running them as CEOs. And that is really what we're referring to in terms of this resourcing is largely on the talent side and capital follows that.
But if you have to take a guess or if you have to predict the condition right now in the venture ecosystem, do you think the supply and the demand of the capital for the industrial tech startups, is it balanced or do you see there's far more demand and the supply is not able to keep up?
You mean demand for capital?
Yes, demand for the capital.
I think it's likely the other way around.
Okay.
I think that there is more capital today than there ever has been. And I think from a demand perspective, founders starting companies, I think it's actually sort of like fairly balanced if you think about going to market with industrial tech. I would have had a very different answer 18 months ago on that, but Andreessen Horowitz did a very strong push into American dynamism, reindustrialization, and sort of like pulled a lot of the market with them. We talked earlier about geopolitical tensions that sort of like revived this interest in national resiliency. And so I think in terms of there being a vibe shift, there's been a vibe shift and it is a sector that is actively sought after versus 18 months ago, 5 years ago, folks were very concerned with the long sales cycles, the sort of risk aversion that came with selling into these cohorts.
Because you mentioned long sales cycles, so what would your advice be for the founders who are actually building an industrial tech, manufacturing tech? Because the sales cycle, the capex, and all those things still matter, right?
That's right. I think we're seeing some shifts in risk aversion and sort of appetite coming from some of those demographic shifts. But what we advise the founders we work with to do is really focus on what we call a control point. So what is that use case or that problem set that when you deliver solution, you have a very measurable ROI in a short time to value. So if you can go to a customer and say, can increase revenue without, increasing costs, and we can do this over a 3-month period, and this is what, like drives value to your business, that's what makes people listen and actually say, okay, I'm willing to not only take on, the risk of adopting this, but also dedicate resources from my business to implementing it. I mean, it is all about sort of what you can measure and prove in these markets.
So what's next for Grid Capital, Jackie?
Yeah, what we're looking forward to with the next year is running a lot of experiments to understand where we can really provide value to the founders we work with, and of course, our investor base. And so from here on out, you'll see us, doing some both small and large scale events is one to sort of bring the community together and be able to create some natural connections. Obviously we do a lot of research and really evangelize for this market and and the companies that we work with.
Awesome. Fingers crossed for you, Jackie. I loved all the explanation that you provided around industrial tech, why it's now the right time, what the startups need to do, how the whole market and ecosystem is evolving. So thank you so much for covering such a broad track today.
Well, thank you so much for having me.
Yeah, thanks a lot.